All right, it's time for our after hours with Stevie Vicks. So, Stevie, I want to start off and ask you. You're actually enjoying a nice, tasty beverage with us. So, what are you drinking today?
So I'm a big fan of German beer. So nice Pilsner Paulaner is what I have right now.
Nice, nice. Is beer your choice, or are you a hard liquor guy?
Well, on a hard liquor, I like bourbon. I like bourbon
Nice.
a lot, but I mostly, do beer. In the summer
Uh,
especially.
yeah, that's Kevin style there. No. All right.
Yeah.
Yeah.
Okay, Stevie, it's Kev. It's Kev here. I got to ask you about some things because I wrote down some of your fun Twitter things, and I got to write. I got to read them to you. Quote unquote from Stevie Vick: super fast rate hikes in 1984 and 1994 have led to the biggest economic years in U.S. history. Hike rates fast is the best way to deal with it. Slow rate hikes freeze financial markets. Get it over with quick. Do it fast and hard. I'm just going to let that one go. So, what do you think, Stevie? Like, what do you think the Fed's making a mistake here by following the market down?
Absolutely. I thought most of the trouble in the market was over. I mean, our target for 2018 was 2450. So at that point, I was like, when it dropped below, it basically started by the market. So I thought it was totally unnecessary. Now here's the problem. What happens is um, when the Fed starts to hike rates, at some point it gets to a point where it starts to freeze the bond markets, right? The junk bond markets, they can't do any issues because people are waiting for the treasuries to go up to a certain level. They can price off the junk bonds off of that, right? And then they can reopen the
Right.
market. So the slow pace of rate hikes was good for the first couple years, but when you get to this critical level, you can't really do it slowly. That's why you've seen in the past the Fed very quickly hike rates, um, and they basically get it over as quickly as possible, right? That's what.
But 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 Stevie, why do they have to hike so fast? Why is it so important to push the economy over the cliff and cause a recession?
Well, I don't view rate hikes as a negative, So you have to understand, like, there's 10 trillion in savings in the U.S., right? So you have to look at the U.S. If you look at the consumer, which is 70% of the spending, you know, a rate cut is not always what stimulates it. Sometimes a rate hike is what stimulates the consumer spending. Now, I'll give you an example. In 2007 and 2008, most of the mortgages were at 8% or 9%, and about 40% were adjustable rate mortgages. It makes a ton of sense then to cut the rate because a lot of people had very high mortgages. If they refinance at a lower level, that opens up a lot of discretionary income out there. With my, you know, um, in my case with my house, when I did my refinancings, I got $500 more money to spend. I went and bought a car. So this definitely works. But once the rates are low as they are now, everybody has already refinanced to a 4% mortgage. Adjustable rate mortgages are only 4% of the mortgage market now. Basically, nobody has them. So what happens now is you've pushed the mortgage rate as low as possible. So you don't really have any more benefit there. But now what happens is if you hike rates, all the people that have savings, and there's 10 trillion in savings, that adds money to the economy. So all the people that that they're retired, they have pension funds, they start to make money. And that by the way, was $100 billion in 2017 with the first rate hike. $200 billion additional money in 2018. People take that money and they spend it. That was the reason why we had a good economy. When he said we're not going to do any more rate hikes, basically people, and we're going to start doing rate cuts, people are starting to cut down on their spending. That's why we're seeing a slower economy today.
Okay, so I'm not sure I buy that completely, but it's interesting to think about. But one of the things I will agree with you, Stevie, is the fact that the idea of continually pushing more and more monetary stimulus into the system in the hope to get people to spend more and more and
Oh,
borrow
come
more and
on,
more is
Kev. It
just
works in Europe.
redonkulous. Like it's just no, it's yeah, and
Yeah, or Japan,
that's
right?
like
Yeah, no, I
yeah,
mean, to me, the whole thing is very silly, right? Like, you look at it, if you look at the GDP, right? The investment spending is only $4 trillion, right? Um, the consumer spending is $14 trillion. So which one do you want to incentivize? Obviously, Republicans always want to incentivize the 4 trillion spending, but that doesn't give you much bang for the buck. If you incentivize consumers, you get much more bang of the buck. So that, I mean, why do you think the Fed raises rates at all, right? I mean, if interest rate at zero was such a panacea, right? We should have kept rates at zero 20 years ago, and would live in heaven, right? I mean,
Right.
why does the Fed raise rates? It raises rates because it actually helps the economy at some point in a cycle.
Okay, so Stevie, the other thing I've been just fascinated by is your argument that beating a 60-40 portfolio, meaning 60% equities, 40% bonds, is becoming easier and easier as the Fed lowers rates. You said something about as the Fed systematically destroys long bond yields, outperforming the 60-40 portfolio will become even easier. There is another lifetime return of about 30% in a TLT. At that point, the long bond will yield zero and its capital appreciation will be maxed out. And then you said, I did everything wrong. I got out of stocks early. I missed the melt up. I missed the mid rally in 2018. I bought some in December, but chickened out the next day. I missed 25% stock rally into Q1. I missed the bond rally twice, yet 60-40 still can't catch me. Why don't you tell us about what you're talking about there and how you're going about beating the 60-40 portfolio?
So in addition to the volatility trading, right, I'm also kind of a financial advisor. So I offer kind of a low volatile account, kind of a 60-40 equivalent account, which has some principles about the permanent portfolio. You invest in bonds, gold, depending on the economic environment. So in that account, basically, my current recommendation for people is to be have like 25% in junk bonds, 25% in gold, and about 50% in short-term treasuries, right, up to 2 years. So very defensive portfolio. So I switched to that mode, maybe without the gold, right? I jumped into gold more recently, but basically in bonds kind of around the start of 2018, right? And basically since then I've missed all of the gyrations and still basically the savings account I have has dramatically outperformed by 10% over the past year and a half. Now, the reason why I'm saying is like basically the lower they put the yields of the bonds, right? So if we go lower and lower and lower, the bonds are basically an automatic portfolio stabilizer. When stocks go down, bonds go up. The principal goes up. So as you make bonds more and more expensive and the yield goes to zero, I mean, if you have a 10-year at 0% coupon, right, that's, cash is better because the 10-year at zero, can only lose money, right? The principal can only go down if rates go up for whatever reason. So
well, I guess it could go negative.
You tell that to the German fund
counter.
owners, right? Like that. Anyway, but.
But what I'm trying to say is like this automatic stabilizer basically loses its power, and basically then it's the equivalent of cash, right? I mean, you're better off sitting in cash, and so then basically that 60-40 portfolio, which what most Americans see, they don't see the stock market, they see the 60-40 portfolio or some equivalent of it, it's going to have a hard time generating the return. So they have one more shot to rescue the system, and after that they blow it up for the next decade of savers.
Yeah, no, I hear you. I agree with you that the diversification benefit, the negative correlation between stocks and bonds is becoming more and more difficult as rates go lower and lower. Is that in essence your argument?
Yeah. So basically, once the bonds are no longer a stabilizer, in other words, they don't go up with the stock market, right? The 60-40 portfolio itself becomes more volatile. And actually, what's going to happen then is that people are going to start to recommend lower stock allocations to reduce the volatility.
That's interesting thought. So your argument is that over time, the fact that bonds have been negatively correlated to stocks has allowed people to hold more stocks than they previously would have been able to do.
That's correct.
And therefore, as the correlation increases, the kind of the risky part of the portfolio
But
will
to
have
what
to be
asset?
It has
reduced.
to be reduced, yeah, to fit the same
Ah,
volatility profile. Because
yeah.
people are mostly concerned about volatility,
Yeah.
less about return.
Interesting. You
Yeah,
know
I
what?
like that.
That's a
That's
great point. I like that, Stevie. I like that. Yeah. So let's talk some VIX, will we? Are you kind of as I grew up and cut my eye teeth trading index arb, and we did a lot of options, and I worked for a bank, so I was always short vol. Are you kind of the same way, or are you one of those guys who actually tries to find points to go long this crazy decaying asset?
So the way I trade it is basically I have a price target for the S&P 500, and if the market is below it, I'm short vol. And if the market is above it, I'm long vol, right? So I had, I was basically short vol in 2016 and 2017, and had like phenomenal returns. 50, in 16, 70% in 70% and more in 16, and 20% in 17. But then I basically turned bearish on the market. So I've been long vol the last 2 years. So last year was the first year when VXX had a positive year. Um, so I was basically flat, because basically I was up 30% and was down 30%, during the rally. Then I recovered it finally at the end of the year. But basically finished flat. So this year I'm also kind of long vol. So it's been a difficult year, but that's how I play it. So yes, it's a crazy decaying asset. But if we do have a bear market, if we do finally have a bear market, long volatility is going to outperform. And based on the analysis I showed you earlier, if earnings start to decline, right, you're going to see
wow.
volatility dramatically increase in the markets. And so I think from here to the election, long vol probably will
See,
be
I
the
love this
best
guy,
performing asset.
Kev. Like, you know what? You were thinking he was going to come in here and be your friend, but I I, I actually guess
They're
yes, but
all of our
but
guests are our
he's
friends.
much
That's
smarter
true. Yeah.
than so. I wasn't gonna
Then what,
say
me?
that last sentence, but you filled in the blanks. But
Yeah.
so generally though, what I want to ask you, Stevie, is like this last sell off. It didn't seem to have a lot of gusto in the spikes in the vol. Do you? What's your intuition? I mean, are we still in the midst of some sort of a sell off? Is there still one more big spike in vol coming here, or do you think that this leg of the market correction may be over, and that something more ominous is like in the second half of the year later on?
Well, as I said, I'm actually, my target was 2450 for last year. For this year, my target is even lower. So I
Straight
think the
down.
market is
So
headed
you're like
straight down.
you. So this kind of a
Um,
rally, you're gonna fade it.
I'm totally fading I've been fading it, from the start of the year. I'm fading this round.
I
I'm
love
fading
this guy,
everything.
Kev.
It has not worked out very well so far. I'm down a lot, but I'm fading it. Um, the thing to understand about the VIX is, so we had a kind of a VIX spike
Yeah,
and everything happened in like 1 hour, or like in one day in the start of the month. So what is happening right now is there's a lot of systematic vol selling, um, and so the VIX get crushed like really
it
hard
spiked.
basically every
Yeah,
time that there's a bottom in the market, right? So that systematic selling, that's kind of Chris Cole's thesis, which I completely agree with. That's going to
right.
go on until it doesn't, right? So basically, you have all these pension funds trying to scrape yield out of it, but they'll scrape yield so long as there's yield. The moment there's no yield, they're going to step out of it, and then actually vol is going to expected vol is going to go even up. So what's happening this year? We have a lot of realized vol. This year we've had so far 5 months, five
Right.
3% months plus or minus, right? Out of 6. Now, just so you know, the record is 10, and it happened like in 2008. So basically, already this year has the volatility profile of a major bear market year. You don't see 3%
Yeah.
months every month, up or down. Normally, Last year it was about 5 or 3 for the whole year, and the year before that was 3. 2017. I mean, bull markets don't move 3% a month. They move, 1%. They go up slowly. So the volatility profile is very bearish. Realized volatility is ahead of the VIX. So here's what usually happens with the VIX. VIX tends to be subdued when the S&P 500 is above the 200 MA, right? So long as the S&P 500 is above 200 MA, VIX is not going to be where you think it's going to be lower, right? Because people basically assume that people are going to come in they're hedged to 200 MA. They don't feel a need to hedge below it. Once you have a break below the 200 MA, that's when the VIX is going to start jumping high.
So now in this rally has been this at least a bear. We'll call it a bear market rally for everyone to know exactly what it is. You and Brent Johnson can have your little kumbaya, Kevin. So this little bear market rally, which ensued up here, it kind of pulled everything back up. But you're in my camp, right? That this is not going to sustain. I love this. This is great. Kev, I'm glad we brought him on. He's a really smart guy.
Look at the 2015 chart, right? Look at the 2015 chart. Thank you, guys. You're too kind with the smart stuff.
All right, so here's the S&P. So you want to go to 2015?
I'm going to have another beer.
You want me to go like on a weekly chart or something here?
Yeah, look at the 2015 chart. Yeah, 2015.
So this is a weekly chart. So.
Yeah, so you see, so you see how it kind of went up. You had like some drops, and you had like, earlier in the year, in March, April, May, it kind of kept grinding up, and every dip got bought as it went up high, right? It kind of did this wedge, right? And so, along this way. So what we're seeing right now is exactly that, right? It went up a lot, now it dropped down. It's probably going to go up to a new high or somewhere close, right? It's going to kind of wind up this thing, and you see the drop happens in the drop of the August drop happened in about third or fourth week of August. That's when you have the earnings. Earnings get reported in July, right? Basically through by that time you have like about 80% of the earnings, and that's right after that it collapsed when the earnings picture for the second half becomes clear. So I think very similar thing will happen this year.
So, Patrick, I just want to say one thing. If Stevie's right about the Democrats doing as well as they're going to do, then we are going to have some trouble, because I agree with his analysis that they are, especially if we get a real left-wing kind of I don't know who are the most left wing of the Sanders. I think there's even worse than Sanders out there. But if we get one of these kind of crazies, left wing crazies, that are going to roll all this back, roll back the tax cuts. Can't even speak, too many beers into it, and the market starts to figure this out. The stock market's going to have a lot of trouble. So
we're
talk
traders.
About me being bullish. I am bullish, but I do agree that if the market starts to sniff out a Democratic win, then we will get into trouble. The only thing that I'm not sure about on Stevie's call is that I'm not sure the market figures it out as quickly as I think he's giving them too much credit.
Well,
they're going to figure it out. Sorry, go ahead, Stevie.
Yeah, so you have to look at 2007 and 2008, what happened. So if you remember, the market topped out in 2007, right, in about October, and after that it was straight down for 2 years during the Democratic primary. And, the market really collapsed after Obama was crowned as a Democratic nominee. So the market is going to start to struggle. As I said, like this summer, you could still have some upside, but then in the back half of the year, it's going to start to think about what happens in the next election, and that's when you're going to start to see this thing being taken more serious, the post being taken more seriously, and so forth.
Okay, so actually, one thing we haven't talked about a lot, Stevie, is your inflation outlook. You went over it early. You gave a very great argument in terms of why minimum wage is going up and why we're going to see more inflation. And I think I've seen you on Twitter talking about how the year-over-year comparisons with the oil increasing are also going to kick in. So on the whole, if I'm correct, you foresee increased inflation numbers going forward. Yet right now, the market is kind of anticipating the exact opposite. How do you think that resolves itself?
So the inflation, basically 30% of inflation is the energy prices. So um, you have oil, went down at the end of the year, but then it went right back up, right? So now it's down a little bit, but I think it's going to recover at some point. So even where it stands right now, oil is up about like 30% on the year, right? So you have 30% going up 30%. So that's going to add you, about a 1% to the CPI, right? Now the trend
Right.
CPI, the core CPI, because of the wage increases and the raise in rents, right, it's going to remain pretty strong at about 2%, right? So then
And we also have the tariffs, right? We have tariffs. Like on the whole,
that's right.
I don't see where, like I see inflation everywhere. And I might be like that kid from Sixth Sense where I just see dead people everywhere. But I really, I think I see inflation everywhere, and I think we're in the same boat. So I'm just having trouble reconciling how the Fed and how the market is pricing in all things fixed income.
Well, yeah, don't go to McDonald's because you're gonna have a headache. You know how much of a meal there is, but it's a when the government tells you there's no inflation, right? When the government denies something, that means there's a problem.
Yeah.
Right?
Right.
If the government telling you there's no inflation, that means inflation. We have pretty strong inflation. But you will see the reading strengthen. I think what the Fed is saying is that this strengthening in the reading is transitory, right? And so that means they can kind of keep the rate low or cut rates a little bit and look through it. But as I said, given where the wages are going, I think the Fed is going to make a mistake. And if you've seen in prior cycles when the Fed has cut rates, so they did that in '98, I believe, right? Immediately after that,
Right.
rates they had to go up even higher because to contain the market bubble. The same thing happened in 2004. They had a couple of extra cuts there to help push out. That triggered a housing bubble, and then they had to really raise rates really fast to contain the bubbles and the inflation.
So Stevie, how do you not worry about that part of it? Because I'm 100% in your camp that is what might happen. But doesn't that imply that stocks go higher, or at the very least, like the Fed is sowing, like is planting the seeds of the next kind of bubble in risk assets?
Well, inflation is not good for stocks, right? I mean, when you have higher inflation, basically earnings go down. And so what you see is like we have a period where stocks go sideways, inflation goes up. I mean, really the best thing to do there is to be in short-term treasuries. And then unless the Fed is doing something like fixing them to zero right now. But
right. But what if the Fed does? What if the Fed leaves rates looser? What if the Fed allows the economy to run hotter for longer?
I don't think they can do that because the banks are gonna, they're gonna have to raise it for the banks. I mean, rate goes up because the banks become insolvent. Now, if you have a democratic government and they say, okay, the banks are going to go insolvent because, banks can't run at rates below inflation, right? I don't think the answer is stocks. The answer is gold. The answer is, the answer is gold and, hard assets. I mean, you basically have a devaluation scenario, right? I've gone through a devaluation scenario where I come from, hard assets and gold is basically the only thing, real estate, that's the only thing that does well. Businesses don't.
Well, okay, so I think we're on the same page there. I do agree with you that hard assets will outperform stocks. So I'm not like, as much as I think that stocks do better than the bears believe, I do believe that hard assets will do better because the Fed will be fixing rates below the rate of inflation. So what do you think happens to gold if what we're kind of envisioning, with the Fed keeping looser for longer? Like, where do you see that going? And the other thing, the next part of the question is, you're recommending 25% of the portfolio in gold. That's a huge allocation. That's like Jim Rickards would be scared about that.
Yeah, I mean, this is kind of a sample portfolio. I basically 25% is my what. So I keep it simple, four things that you want to be looking at. So something I want to mention for the next cycle is basically what's going to happen is investors are going to start to go into things that have preference over stocks. So I really think stocks are in big danger because basically when earnings go down, right, you have to focus. Investors are going to focus on the capital structure that gets paid first, and that's investment grade bonds, and then after that, junk bonds, and then after that, there's going to be no money left for the stockholders. Okay, so that's why I like I think in that scenario you want to have junk bonds. They pay a high coupon. Maybe higher yielding liquid bonds. Investment grade bonds if you can, and also gold, right? So if those goes down in value, the gold will offset the principal. But gold based, the way I value gold is based on the size of the balance sheet. So they were at 4.5, 2,000 gold. When they said it's going to go to 2.5, my gold projection was for about $1,000, right? So now they said we're going to go to 3.75 or something like that. That means the gold price should be around 1,600. Now, if they start to do these other experiments, now yield curve control, keeping the short rates at zero and all that stuff. I don't think these things can happen as easily as people think. And I think in the next recession, the Fed is really going to look. So one of the things I need to mention is all the reviews of Fed monetary policy have said that basically the QE, what the Fed did, was not very effective in suppressing long-term rates. And so their goal was in 2008 was to suppress the long-term rates so people can refinance their mortgages. And instead, what happens, and this is, John Taylor just had a presentation about this. Instead, what happens is the 10-year rate just went up, right? So
right.
the QE has been deemed a complete failure. So what the Fed is instead going to do in the next time around, and they don't have as much money anymore, right? Because debt to GDP ratio is hard. They have a bigger balance sheet now. They're just going to focus on the long-term debt, try to suppress that to get people to refinance. Right, so they want to. They probably want to have a flat yield curve, but it's not going to be at zero. I think they want to have a flat yield curve at 2%.
Okay, well that would be terrible for us guys that are long fixed income volatility. Anyway, Stevie, it's been a pleasure having you. Why don't you just tell people again where they can find you and where they should follow you on Twitter?
So again, it's at vixcontango.com. On Twitter, my handle is @vixcontango. So be careful because I, make my opinion.
The disclaimer: be careful.
It's not for everybody.
I can definitely attest to that because you've over the years. I think you and I met originally on Twitter, and you gave me a hard time about one of my views, and I was like, there's Stevie. I can always count on him making sure that he keeps me honest, and that's always what I appreciated. And it's been a ton of fun having you on, Stevie. Thanks very much for coming today.
Thank you for having me.
All right, Steve, I got to ask you before you go. So you said talked about buying gold, and you said where I'm from. So where are you from? Like, where did you experience all of your opinions on gold and everything?
I'm originally from Bulgaria,
Okay.
which is Eastern Europe, and I came here very young as a teen, in high school.
Right.
So I lived in the United States for 30 years.
Right.
But in the 90s there was when communism fell down and we changed to capitalism, there was kind of a period in the mid 90s where there was basically massive currency devaluation. So everybody lost their savings. My grandfather, everybody that had any savings lost everything.
Wow.
And people like my father who were in business, who had hard assets. So I'll tell you a story of my father, how he got rich. He was importing air conditioners from abroad, right? So he got out this huge loan in the Bulgarian currency, right? And he bought out this massive amount of air conditioners, and then right at that time they do this currency devaluation. So his debt, 1 to 1,000. So his debt goes from like $1 million to $1,000, right? I mean, completely. So he then after that he sold one device and then
His
paid
debt
off his
was
debt.
paid off. That's fucking
paid off.
amazing.
Paid off. So he
Those
got
are
rich, but but my grandfather lost all his savings. You know.
all right. So Stevie, thanks a lot. It was a great interview.
Thank you guys for having me.